Welcome back to the channel, guys. Have you been looking for a place to put your investment or your money? Today's video is going to take a look at the different options that you have available, different funds, pros and cons of what they are, and also the secret about risk that you might not be aware of. You may have clicked on my channel for the very first time, but I promise you, if you stick around to the end, I will get you some information, some tips that may change your investing future forever. That is a pretty bold claim, I know, but stick around for the video and see if you can learn something. What's the worst that can happen? You spend 10 minutes of your life. What's the best that can happen? It can really change your future. If you get value out of this video, hit that like button and share it with a friend. I would love that. It might make my day, maybe even my week. So thank you. Let's jump in. I will do my best to pass on what I learned from actively trading more than $6 million worth of trades, reading more than 50 finance books. So I hope to be able to look at this information and share some golden nuggets with you. Why is this important? Because investing is hard. It's not an easy thing to do. The statistic is about 1 out of every 4 active investors actually makes money. Even if you look at the professionals, only 5% of professionals actually beat the market in about a 15-year period. There's a study out there that looked at 40-year periods to see what's the effect of a long-term investment period on professional money managers. Do you know how many actually beat the market in 40 years? Are you sitting down for this? Less than 1% actually perform better than the stock market of actively traded funds. These are professionals. This is their life. This is their passion, and they suck at it. Now, of course, you and I, we're much better because 95% of people are the top 5%. Wait, that doesn't quite add up, does it? Well, that's how we feel a lot of times. Another reason why you can have a hard time jumping into investing is because the investment community or the industry makes it seem very complicated. They use various different instruments and derivatives of derivatives to the point where we don't even know what the heck they're talking about. So let's take a look at the different options. So what is investing? What are stocks? How can you make money investing? What are different types of investing? What kind of results can you expect? And what are the common pitfalls of investing? Those are all really big questions. So let's kind of run through them really quick. So what is investing? Investing is simply you taking money and putting it into an instrument or an asset, something that you hope is going to go up in value. For example, you're going to go out there and you're going to buy some Home Depot stock. And Home Depot starts making more money. They sell more lumber because lumber skyrocketed. And when they make more money, guess what? The stock that you bought, which is a part of their company, it also goes up in value. That's called investing. Maybe you loaned your money to the government, and the government's gonna pay you back with some interest. That's also investing. Or maybe you bought some Bitcoin, and Bitcoin is starting to fly up through the roof. That's also investing. So what are different ways to invest in the stock market? For example, you like technology, but you don't really want to invest into the whole stock market. Let's say you want to pick a company that makes microchips, so you buy AMD. Maybe you want to buy a company that makes computers, so you buy Dell. Or maybe you want to choose the whole industry that makes computer chips, so you buy into the semiconductors industry. Or possibly you buy into the whole technology sector, which includes people who make computers and microchips, AI. That's a much bigger basket. Or if you really want to be safe, then you choose the whole entire stock market. Now, can you see the difference in your risk level, in your exposure? So one of them is very risky. What happens if that company that you invest in goes down in value? Your whole portfolio goes down in value. But if you invest in the whole sector, it's not gonna go down in value that much. The reality of technologies losing value over the long term, not likely. So does your level of risk change with different types of investing? Of course. So if you buy an individual company, basically that company can go up and down in value and your whole portfolio is tied to that company. But if you spread your risk, called diversification, you kind of spread it out among different companies, your risk goes down. I mentioned already that I've traded through about $6 million worth of active trades. What have I learned from it? Let me show you a little bit of what I have learned. So here's my small binder that I have used to keep track of my trading. It's gonna be hard for you to see, but at least I want you to have a rough idea. I started trading and I kept track of my trades, my emotions of my trades, what I thought was gonna make me money, what I thought wasn't gonna make me money. That's a thick binder. And what have I learned out of all of this? Investing in individual companies is a very, very difficult task. I couldn't do it. What's the chance that you could do it? It's possible, but the odds are stacked very heavily against you. Like I mentioned, a lot of the professional money managers, within a 15-year period, only 5% can beat the market. So instead of trying to beat the market and trying to hope that you can win and be the 5% of professional money managers, why not just join the stock market instead? Why not be the benchmark that beats 95% of professionals? Let's go over the 5 options. The first one I would go over is VASIX. It's a fund by Vanguard. I'm gonna pull it up here on the screen. And if you had invested $10,000 in the year 2005, about 15 years later, you're gonna have $22,530. And if you notice the chart, it's pretty smooth, sloping upward. Doesn't have the fastest return, but it has very muted downward risk. In other words, if you're gonna retire next year or 5 years from now and you're concerned about risk, this is a great option. This really minimizes your downside while continuing a steady upward trajectory for your money. Our next option is VTXVX, also another Vanguard fund. So these are typical through your workplace for a 401k, where you expect that by retirement you're gonna have a safe bet. As you can see, this one grew to $28,545, which is a good return. However, look at what happens in the year 2008 when the market crashed. This fund was a retirement fund for 2015. So within 5 years from retirement, this fund lost a lot of money. It went down almost the same as the market as a whole. So this fund doesn't really prevent the downside, and it also minimizes the upside. So most of these target date funds, they're not very good options for you. They tend to be expensive, and they tend to not have as much upside gain while also not preventing too much of the downside. So you're gonna crash if the economy crashes, and when the economy shoots up to the moon, this fund will prevent you from making a lot of money in the up move. The third option is gonna be the S&P 500 index. The S&P 500 has grown more than the other 2 funds. So if you had put $10,000 in the year 2005, about 15 years later, you would have $40,252. However, this fund also goes down substantially when the market goes down. Because if the market goes down 50%, this fund goes down 50%. Now the fourth option is gonna be a little bit more aggressive. Here I wanna give a little bit of a caveat. The fourth one is a technology fund. It's the NASDAQ. So the NASDAQ is more volatile. It goes up and down more. $10,000 invested in the NASDAQ from about 15 years ago would be worth a little bit more than $108,000. However, not everybody can manage that volatility. What do I mean by this? When your money goes down by a certain amount, most people will start to panic and think something has changed. Something is different this time. This time, the economy is not gonna bounce back. It's gonna be a whole new type of change in the future, and it's never gonna be the same as the past. So they pull their money out at the worst possible time. However, this fund doesn't just drop a lot, it also shoots up a lot. So the volatility is not just downward, but also upward. As you can see here, especially towards the end, when the technology sector jumps up, this fund kills all the other funds. Guys, this 5th fund is by far my favorite fund. This one is the Fidelity Select Software and IT Portfolio. Why do I like this fund so much? Let's dig into it a little bit. Now, if you have made it this far in the video, hit that like button. And if you guys find value in it, please share this with other people that you know. So let's pull this up on the screen. As you can see, the results are quite amazing. $10,000 invested about 15 years ago would be worth $175,705 today. That is a growth of over 18%, over 15 years. That includes a massive market crash. But that's not the whole story. This is the most important part of the video I wanted to show you guys. Let's say you started investing at the worst possible time, right before 2008 crash, and you invested your money. Here's the different options you could have went with. If you see the solid blue line, that is the VASIX SIX fund. That's the super steady fund. In 2008, when the market crashed, that fund barely went down. As you can see, it ended 2 years later at about $9,348. The other funds all dropped. If you look at the S&P 500, the general market itself, it actually dropped more than 40%. At the worst, it was actually over 50%. That is not very good risk protection, even though you're well diversified in the whole stock market. So our slow moving retirement date fund that was supposed to be super safe because we're retiring in the next few years, it also went down quite a lot. So it didn't save us from a lot of risk in the market. The reason why I love that Fidelity fund, FSCSX, did it drop? Yes, it did, but it only dropped by about 25%, as you can see here. Let's see what happens as you start moving forward. Here we can see that a few years later, the crash is a little bit behind us. All the funds start moving up. However, the S&P is still negative, so the general market still hasn't recovered. Our very solid performing safe fund is up about 14%. But look at my favorite fund. Not only is it up, but it's actually up higher than the most safe fund. And there was a huge crash that had just happened a couple years earlier, one of the biggest in history. Let's jump forward a little bit. Here we have about 7 years later, and our crazy Fidelity fund is up to 207%. So your $10,000 invested through the crash of 2008 would be worth over $30,000. And if we jump ahead to right now, if you had started investing right before the market crash and you had invested in the most safe fund, your money would be worth $19,000. That is a pretty good overall return. You never suffered a lot when the market went down, but it also didn't grow a lot. This is the part I really want you guys to understand. Risk is a funny thing. People can say the more aggressive a fund is, the riskier it is. However, if you retire even this year, how long is your retirement gonna be? We never know for sure, but let's say I retire at the age of 60. I hope that I can be retired for at least 15 years. So in this 15-year period, including a huge market crash, the best fund was not the most conservative. If you can't stand risk, or if you wanna make sure you protect your money, go with the fund that is a solid performer. It can be a mix of bonds and stocks. It won't drop a whole lot in the market, and it is gonna keep holding steady, but it won't grow a lot. If you guys wanna grow your money, even if you're close to retirement, look at certain funds that can grow. The last fund that I like so much, FSCSX, the Fidelity Software IT Fund, not only did it grow to an amazing amount, but it also doesn't drop as much as the general market. So you're prevented the crazy downside risk while maximizing upside potential. So people will say this fund is risky, correct. But do you know why it's risky? Because it's risky on the way up, more so than on the way down. And maybe you don't want the risk on the way up. I do want the risk on the way up. That's where most of my money is gonna be made. I'm not sure what else I can say to convince you to start investing and to really put your money to work for you. What can I say that's gonna make you stand up and go and invest your money? I really hope that you guys, after watching this video, first of all, will hit the like button if you learned something. And second of all, I hope that you will look at your portfolio wherever your money's at. You're gonna open up your 401k and figure out where is your money sitting. How conservative is it? Is it a normal retirement date fund? Maybe you guys can choose a better option. So if you have any questions, or if you have comments, if you think this is a great idea, comment down below. And if you think this is way too much risk and I shouldn't be giving people these crazy funds, let me know. I wanna get some feedback. And as always, I did wanna show you guys my Roth IRA, where I'm at right now. So here's the growth over the last 2 years. Thank you for watching the video. Thank you for spending your time with me. I appreciate it. I also appreciate if you hit that like button, and also even more so if you share this with a friend. I want to grow this channel to benefit more people, and the only way I can do it is if you help me grow. So let's grow together. I appreciate you spending your time with me. I wish you well. Artie out. Now let's see how many people will actually go and research these funds. I hope you're one of those people, because I think it can really change your future. I will see you again next Thursday, right here on this channel at 3:30 Pacific time. Thank you for your time.